Quick question. When you reconcile your IOLTA account, what are you actually checking? If the honest answer is, I make sure the bank balance matches what's in Clio, I need to stop you right there. Because that's not a reconciliation, that's one third of one. Law school teaches you not to touch client funds you shouldn't touch. It doesn't teach you how to actually verify your trust accounts every month. Most attorneys learn this the hard way, usually from a bar auditor. You don't want that. Today, I'm walking you through the real three-way reconciliation, what it actually checks, why two-thirds of it usually gets skipped, and what happens when it does. Let's get into it. Hey everyone, I'm Peter Fider. I'm a CPA and the founder of Meatball Accounting. Yes, it's called Meatball Accounting. We work with law firms on IOLTA reconciliations and bookkeeping. If you want to actually understand what's supposed to be happening inside your IOLTA every month, not just trust that it's fine, subscribe. That's exactly what this channel covers. Let's talk about three legs. I call it three legs. Okay. Now, leg one, what it is, what it catches. Bank balance. The actual balance sitting in the IOLTA account at the bank per the bank statement confirms the account itself is accurate, but nothing more. Book balance. The trust balance shown in your accounting software or Clio Trust Ledger confirms your internal records match the bank. Client ledgers. The sum of every individual client's trust balance added together confirms no single client's funds are covering a shortfall in another's. Here's the part that trips people up. All three of these numbers have to match, not two out of three, all three every month to the penny. A lot of firms stop at leg one. They see the bank balance matches their software and they call it done. But here's what that misses. Your software can show a balance that matches the bank perfectly, while one client's ledger is negative and another client's is quietly covering it. The bank will never show you that. Only the third leg, individual client ledgers, catches it. Let me make this concrete. Say your IOLTA is $50,000 in it, and your books also show 50,000. Bank and books match. It looks clean. But underneath that $50,000, client A's ledger shows $12,000. Client B shows negative $2,000. And eight other clients make up the rest. Client B's balance being negative means their case somehow used more of their own trust funds than they had, which means someone else's money covered it. That's commingling, and it's invisible unless you're checking leg three. See how does this actually happen, right? It's almost never intentional. A disbursement gets coded to the wrong client. A retainer gets drawn down before the corresponding invoice is entered. A filing fee gets paid from the wrong client's balance because two matters were open at once. Small clerical errors, not theft, are what usually causes this. So what does a real monthly reconciliation actually involve? Three steps. Step one, reconcile the bank statement. Standard reconciliation, same as any bank account, confirm the ending bank balance matches your books, accounting for any outstanding checks or deposits in transit. Step number two, pull the client ledger report. Run a report showing every individual client's trust balance, add them all up. That total needs to equal your book balance from step one. Step three, investigate any variance, no matter how small. If the three numbers don't tie out exactly, stop and find out why before moving on. A $10 variance left unsolved in January is a 10-minute fix. The same $10 variance, unexamined for 11 months and buried under hundreds of transactions, can take weeks to trace. Most state bars now expect this three-way reconciliation to happen monthly, and some require it to be documented and ready to produce on request. Not doing it isn't just a bookkeeping gap, it's a compliance gap. The firms that never have a problem here aren't the firms with the most careful attorneys. They're the firms where someone is checking all three legs every single month without exception. Quick recap of what we covered. A real reconciliation checks three numbers: bank, book, and client ledgers. Matching just the bank statement only confirms one third of the picture. Client ledgers are the only place that catches one client's funds covering another's. Most commingling starts as a clerical error, not theft. Any variance, however small, gets investigated immediately, not carried forward. Most bars expect this monthly, documented, and ready to produce. I put together a free guide, The Five Secrets to IOLTA Compliance for Law Firms, that goes deeper into this and the other mistakes that put a firm at risk. Links in the description. And if you'd rather have someone else run this reconciliation every month, bank books in every client's ledger, tied out to the penny. That's exactly what we do at Meatball Accounting. Book a free 30-minute trust strategy call. Link is also in the description. If this helped you, hit that thumbs up. It genuinely helps other firms find this content. Subscribe for more trust accounting content for law firms every week. I'm Peter Fider, CPA. Thank you for being here, and I'll see you on the next one.